Welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Stochastic RSI Trend Pullback. This strategy blends two familiar ideas, following an established trend and waiting patiently to enter on a pullback. It uses a smooth stochastic RSI oscillator to time those entries and a moving average filter to stay on the right side of momentum. By the end of this video, you'll understand how the logic works, what each parameter does, and how a sample long and short trade might unfold. Let's get started. So what exactly does this expert advisor do? At its heart, Stochastic RSI Trend Pullback is a trend-following strategy that tries to enter during temporary pauses, rather than chasing price at the extremes. The idea is simple to describe. First, the strategy decides which direction the market is leaning by looking at an exponential moving average, or EMA, of closing prices. When price is trading above a rising EMA, the environment is treated as an uptrend and only long ideas are considered. When price is below a falling EMA, it's treated as a downtrend and only short ideas are considered. This filter keeps the system aligned with the broader flow of the market. Second, the strategy times its entries using a smooth stochastic RSI oscillator. This is a momentum tool that takes the classic RSI and normalizes it to its own recent range, producing a value that swings between 0 and 100. When that oscillator dips into its lower zone and then turns back up, it suggests a pullback inside an uptrend may be finishing. When it pushes into its upper zone and then rolls back down, it suggests a bounce inside a downtrend may be fading. The combination is what makes this approach interesting from a study perspective. Trend agreement plus a reversal from an extreme aims to enter at a relative discount while staying on the side of momentum. Risk is handled with the average true range, or ATR, which measures volatility. Both the stop loss and the take profit are sized as multiples of ATR, so the trade maths automatically scales with how active the market is. This kind of EA is generally studied by traders interested in systematic, rules-based approaches on a single time frame, who prefer waiting for confluence over frequent activity. As always, remember that trading involves risk, losses do happen, and nothing here is a promise of any particular outcome. This is educational information only. Let's walk through the mechanics step by step, exactly as the code executes them. The expert advisor works on completed bars only. On each new bar, it looks at the bar that just closed and updates its calculations, so it isn't reacting to unfinished, flickering candles. The first calculation is the RSI, using a default length of 14. That RSI series is then fed into the stochastic RSI. The strategy looks back over the most recent 14 RSI values, finds their highest and lowest points, and normalizes the latest reading into that range. A value near the bottom means RSI is near its recent low. A value near the top means it's near its recent high. This raw figure is then smoothed by averaging the last three values into a single line the code calls %K. Next comes the trend filter. The EA calculates a 50-period EMA of closing prices and compares the current EMA to the previous bar's EMA to measure its slope. For a long setup, two things must be true at once. The closing price must be above the EMA, and the EMA must be rising. For a short setup, the close must be below the EMA, and the EMA must be falling. Now the entry timing. For a long, the strategy watches for %K to have been below the oversold level, which defaults to 0.20 or 20 on a 100 scale, and then to cross back up to or above it on the current bar. That upward cross out of the lower zone, while the trend is up, is the long entry condition. The short is the mirror image. %K must have been above the overbought level of 0.80 or 80, and then cross back down through it while the trend is down. The EA also allows only one open position at a time for its magic number, so it won't stack trades. When an entry condition is met, it measures the current ATR over 14 bars to size the trade. For a long, the stop loss is placed 1.5 ATR below entry, and the take profit 2.5 ATR above. For a short, those distances are flipped around the entry. Because the target distance is larger than the stop distance, each trade is structured with a reward that is roughly 1 2/3 times its risk. The position then simply runs to its stop or its target. Let's look at the actual MQL5 code running inside MetaTrader. At the top are the input parameters, and these mirror the strategy's settings one for one. You can see the RSI period set to 14, the stochastic lookback also 14, the smoothing length of 3, and the 50-period EMA that acts as the trend filter. Below those are the oversold level of 0.20 and the overbought level of 0.80, the ATR period of 14, and the two multipliers that control risk, 1.5 for the stop loss and 2.5 for the take profit. There's also a fixed lot size and a magic number that tags this EA's trades. Moving down, the code defines the trend regime. The uptrend flag is true when the close is above the EMA and the EMA is above its previous value, and the downtrend flag is the exact opposite. Then come the two signal lines. The long signal requires an uptrend, plus the previous %K below the oversold level and the current %K at or above it. The short signal requires a downtrend, plus the previous %K above the overbought level and the current one at or below it. Finally, the two order blocks. When the long signal is true, the code reads the ask price, sets the stop 1.5 ATR below and the target 2.5 ATR above, and calls trade.buy. When the short signal is true instead, it reads the bid price, places the stop 1.5 ATR above and the target 2.5 ATR below, and calls trade.sell. Both sides share the same clean, symmetrical structure. Now let's bring it all together on a chart and walk through both a long and a short example, candle by candle. On the lower panel, you can see the stochastic %K line in gold, with the overbought level at 80 marked in red and the oversold level at 20 marked in green. We begin on the left, where price is drifting lower into a shallow dip. Notice the broader context. The market has been working higher, so the strategy is watching for a long. As these first two candles print, the gold oscillator line is falling fast, sliding out of the middle of the range and pressing down into the green oversold zone below 20. On the third candle, price makes its lowest point of the pullback, and the oscillator bottoms out deep in oversold territory. This is the moment the strategy has been waiting for. It doesn't buy simply because the oscillator is low. It waits for proof that the pullback is finishing. That proof arrives as the oscillator turns and crosses back up through the 20 line. With the trend still pointing up and price holding above its moving average filter, the long entry condition is met, and you can see the buy entry marker appear near the low. At this instant, the expert advisor measures the ATR and sets its protective stop below the recent swing low, roughly 1.5 ATR away, with the take profit target placed 2.5 ATR above. That's a reward of about 1 2/3 times the risk. Now watch what happens. Price lifts off the low and begins a steady climb. Candle after candle closes higher. The oscillator swings up through the middle of its range, and momentum carries price toward the target. A few candles later, price reaches the take profit level, and the long trade closes at the take profit marker. That's the full life cycle of a pullback entry inside an uptrend. Wait for the dip, wait for the turn, then ride the resumption. Now the picture shifts, and we get our short example. As price makes that final push to a fresh high, the oscillator drives up into the red overbought zone above 80, its highest reading on the chart. Price then stalls and prints a candle that fails to make further progress. The trend context is now rolling over, with price losing its grip on the moving average filter to the downside. The short setup completes just as the long one did, but in mirror image. The oscillator, having pushed above 80, turns and crosses back down through the overbought line. With the trend now leaning lower, the short entry condition is met, and the sell entry marker appears near the high. The expert advisor places its stop above the recent swing high, again about 1.5 ATR away, and sets the take profit target 2.5 ATR below, keeping that same reward to risk shape. From there, price rolls over and works steadily lower. Each candle closes beneath the last. The oscillator slides back down through its range, and the decline carries price down to the target. On the final candles, price reaches the take profit level and the short trade closes at its take profit marker. Notice the symmetry across both trades. In each case, the strategy first confirmed the trend direction, then waited for the oscillator to reach an extreme and reverse before committing, and finally let a volatility-based stop and target manage the outcome. That patience and structure, entering on the pullback rather than the extreme, is the whole idea behind this approach. That brings us to the end of our breakdown of the Stochastic RSI Trend Pullback Expert Advisor. We covered the core idea of buying pullbacks inside an uptrend and selling bounces inside a downtrend, how the smooth Stochastic RSI times those entries, how the EMA keeps the strategy aligned with the trend, and how ATR sizes the stop-loss and take profit on every trade. We also walked through the actual MQL5 code and a step-by-step chart example. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation to trade. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like to see next, and subscribe for more MT5 strategy breakdowns. You can find more at www.OversoldLevel. Past performance does not guarantee future results. Trade responsibly.